And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show. Of course, it is Tuesday as we get things underway this week. Of course, earnings really starting to pick up pace. And interestingly enough, this has kind of been a trend as of late, really over the last few years when it comes to earnings season, is that earnings beats. So if companies beat both headline earnings estimates and revenues, on average, the rewards have been okay, but not fantastic. Now, there's always some exceptions, right? You'll see a company come in and really kind of clobber estimates, and they'll be up, some big double-digit amount. But on average, when you take a look at the average kind of reward for companies beating earnings estimates and revenues, it's been okay, but not fantastic. However, punishment for missing has been much greater. And this has really kind of been the trend of the last few years. So again, expect a pickup in volatility as we, kind of continue to move forward here over the next couple of weeks as companies report these earnings and we continue to kind of see this pickup, and expect if companies do miss earnings, they are going to get punished. So you may wake up one morning and see a position or portfolio down sharply because of an earnings miss or a warning, etc. And we're certainly still in that environment where we have the risk that we're going to see some warnings. Even though we're seeing economic data improve and we're seeing things improve in terms of consumer sentiment, there's still some risk to the economy this year. Leading economic indicators came out yesterday, and this has been one of the big conundrums for a long time. The leading economic indicators are supposed to lead the economy, right? They're supposed to tell us, when we should expect a recession or expect growth. And the leading economic index has been negative for 21 months. It's been one of the longest stretches on record, and of course, no recession yet, right? So this has been one of the big conundrums for the markets, is all these economic indicators suggesting that we're going to have a recession, yet we haven't had one. And economic growth continues to kind of just chug along. Right now, the Atlanta Fed's expecting about 2.5% growth in the fourth quarter of 2023. So we're about to get the GDP numbers coming in here soon. That's expected to be over 2%. Goldman Sachs has just moved their economic growth indicator for quarter four above 2%. Of course, this is coming off of a near 5% clip in quarter three. So again, all these big concerns about economic recession, contraction, etc., just haven't manifested themselves. Now, it doesn't mean they won't at some point. They just haven't yet. And that's the risk as we move forward this year. Is there something on the horizon that is going to crop up and really start to show some weight on the economy? And will companies start to acknowledge that, and that's the risk to earnings, right? The outlook to earnings for the rest of this year. So when the company reports, Procter & Gamble reporting this morning, reporting $1.84 right now on earnings. Stock's going to be up about 6% this morning on that news. It's good for us. We own it in our portfolio, so we like that. But the rest of this year, what's that going to look like? Where's growth? So, these conference calls from these CEOs are going to be very important. CEO confidence remains very low. Their outlook isn't great overall in terms of the surveys. But listen to what these companies say about the state of consumers, right? Are consumers buying more? Are they strong? Et cetera. Inventories for these companies remain very high. So again, there's still a lot of inventory build that's out there, and that occurred, following the pandemic. We had all these companies stock up on inventories because of potential disruptions to supply lines. Those inventories still remain very high. So if those inventories don't get moved, at some point they're going to have to start discounting those inventories to get those moved. That's disinflation, slower economic growth, et cetera, all weighs into that. So again, just kind of things to be paying attention to. Okay. Let's talk about the most stupid chart on the planet this morning, put out by Ryan Carson. I put this on Twitter, but basically it's just a chart showing that when stock markets make all-time highs, that stock market all-time highs occur in clusters. And this was an amazing piece of research. Somebody must have spent days working on this analysis. Of course, all-time highs remain in clusters, because once you make an all-time high, guess what? You're in a bull market. So today, if the market is up, right now the NASDAQ is up 26 points before the open, we're going to have a new all-time high. So every day the market goes up from here, it's going to be an all-time high. So yes, all-time highs always occur in clusters. And the reason they occur in clusters is because during periods where you're not making all-time highs and you're in a bear market, you're in a bear market. So that's why you don't make all-time highs. So anyway, this is the point of all this. So here's what you need to know before the bell this morning. We're going to make an all-time high today. They occur in clusters as we continue to move up here. Triggering that MACD buy signals we talked about yesterday. Also in the commentary on the website. So if you're not getting our daily market commentary, go to the website, realinvestmentadvice.com, and subscribe, and we'll email it to you in the morning. But one thing we've talked about over the last couple of days is that we're about to trigger this MACD buy signal. We'll do it today, actually. And we're already back to overbought. So our RSI is back above 70. You're triggering a MACD buy signal from a fairly high level here. And we've seen this before. Now, this certainly doesn't mean anything other than the fact that you can certainly continue to kind of grind your way higher. And as we've talked about before, is that if we go back and look at a similar period where we did this back in this June-July period of last year, the markets got registered a sell signal at a fairly high level. Markets were very overbought at that point. We worked off some of that overbought condition. But the MACD never really corrected, triggered another buy signal, and the market continued to advance for a while. And again, so there's a real possibility that we get some further upside here. That wouldn't be surprising, because once you make an all-time high, you kind of get that momentum, that exuberance, that fear of missing out. So a lot of money wants to come into the markets. It's also a new year. So money wants to come into the market. They want to participate. So this certainly suggests that markets can kind of grind their way higher here for a bit. But eventually you're going to flip this sell signal back over at some point. There's not a lot of upside before you're eventually going to just kind of exhaust the market, exhaust buyers, and you're going to get that next sell signal. Of course, when we did trigger that next sell signal and then we did work off that overbought condition, that was during that 10% decline through October of last year. So again, this is not uncommon that you're flipping signals at a fairly high level. That's just simply a sign of exuberance. It's kind of a sign of money flows coming into the markets. Absolutely nothing wrong with that. It does suggest that upside is somewhat limited in the near term. Now, again, that could be 3, 4, 5% higher. But before you're going to go substantially higher in the markets, you're going to have to work off this overbought condition, reset the market in terms of buyers and sellers to a degree, and then that's what allows you to have the next advance in the markets. It's just the cycle of the market and how it works. But again, we're just with this advance that started back at in October, beginning of November, is very long in the tooth. We've talked about these buying stampedes and selling stampedes. This has been a very long run of a buying stampede. So again, there's just simply a function of money, right, that's out there. And if you take a look at cash allocations of investors, they're getting fairly low. A lot of equity allocations, very little cash. Buying power is starting to get limited here to a great degree. And so everybody that's wanted to buy stocks have already bought stocks, and that's why you get these buying stampedes. But again, eventually, and don't know when it's going to happen or what's going to cause it, you will get the opposite of that, which will be a selling stampede. That's where you'll get a correction. That'll obviously give you a much better point to add aggressively to your portfolio. Again, we're in a bull market, nothing wrong with that. And again, you want to honor the fact that we're in a bull market, but use corrections and pullbacks to make better entry points. But again, right now, everything's fine. We're going to trigger a buy signal, suggest higher highs here over the next couple of weeks as we wrap up the month. That's what you need to know before the bell this morning. When we come back, we'll talk a little bit about today's blog post about all-time highs and what that means and why there's some disparity. Talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. A lot of stuff going on, of course. We're trying to get ready very quickly here for the summit this weekend with Greg Valliere. So if you haven't got your tickets yet, there are a few left. It's the seating in the back. No, it's open seating. Just get there early. But if you want to come to the summit this weekend, there's still a few tickets left. You can go online right now. There's a banner at the top of the webpage, realinvestmentadvice.com. Just click on that banner and you can get your ticket. Love to see you there. So a couple things. It was interesting. So Newsmax reached out to me and asked me to write an article about all-time highs. And, there's... And it's interesting because there's this bifurcation between the news, right? So if you watch CNN or Fox or Newsmax, etc., you get very different opinions about things, about what's going on in the economy. But what's interesting more than anything is that on a consumer basis, consumers are not real exuberant about the economy. And, and so there's this kind of the detachment, right? We got all-time highs in the markets, And yet, if you take polls, right, from consumers, et cetera, they're not real happy. And, because they're just trying to make ends meet. They're just trying to, try to get things taken care of for their family. And it's just tough, right? Things are expensive. Inflation's a problem. And I thought it was interesting because there was a poll. So Axios, which is a very left-leaning website, and they, very supportive of the current administration. And the reason I picked their survey is because of that. But, and the reason I picked that particular poll to make this comment is that, right now there's all the support, from left-leaning websites, et cetera. They're trying to support the Biden administration for the election, right? So that the election is right around the corner, and you don't want to go into an election with a bad economy. That's just that's not going to get you to win if the economy's bad when you go into election. And so the economic data is not bad, right? We take a look at GDP, we take a look at, economic indicators. Unemployment rates are low. So lots of stuff to run on. If I'm President Biden running for office, I'm touting the strength of the economy. I'm touting the strength of unemployment. I'm touting wage growth. That's there, right? I'm touting stock market all-time highs. But I thought this was an interesting statement from Axios. This is a quote directly from Axios. Poll after poll shows that the country is bummed out by the economy. Voters blame Biden. Now remember, this is a left-leaning organization, right? Voters blame Biden. Nearly 4 in 10 Americans rate their financial situation as poor, according to a new Axios Vibe survey by the Harris Poll. In the language of our new Vibe series, which taps into the depth of Americans' feelings, those surveys feel sad about jobs and the economy. But wait a second. We've got the stock market at all-time highs. Unemployment is at historic lows. Jobless claims are at historic lows. So what's there to be bummed out about? Right? This is the great detachment between what the media tells you, right, and what the stock market tells you. I mean, if you just looked at the stock market making all-time highs right now and having rallied sharply since October of 2022, if that's all you looked at as an economic indicator, you'd say everything's fine. But there's this big detachment. We compile a sentiment index. So, we have University of Michigan consumer sentiment. You have the Conference Board sentiment indexes. So we compile a composite of both of those sentiment indicators, just try to get a broader measure. And it's interesting right now, there is a very big detachment between current expectations or current situation and future expectations. I have a chart of this if Brent will bring it up for me. And so it's one of the deepest that we've had in quite some time. And it doesn't, necessarily mean anything other than there's just a very big break between how people feel now versus what they think the future is going to be like. Right now, they're very negative. And so when we talk, and this is, again, this is at the time that we're now making all-time highs. And so we can kind of break this out a little bit, and we can kind of look at the composite index in terms of both the current conditions and expectations, just individual components. Fed funds, of course, have risen sharply. So, that rise, whenever the Fed's hiking rates, right, that raises borrowing costs for individuals. And it's not surprising that as a function, they're under pressure. Higher interest rates, I can't buy as much. Things cost me more. I can't buy a house, whatever it is, right? I can't afford a car because of the interest rate. So naturally, they're bummed out. And so that all kind of makes, complete sense, but you would expect, that to be reflected in the stock market, right? And it just really hasn't been. Now, what is good news, though, is that the lift in the markets is improving that confidence. Going back to that chart, consumer confidence is improving. It's still very low. It's still well deviated from its previous peak. I mean, you take a look at consumer confidence, they're not overwhelmingly happy, right? But it is improving because the stock market is going up. They feel better, and naturally that should translate into a pickup in economic activity, right? I do feel better about the markets. I feel like I have more money. There's more money in my 401k plan. So I'll go spend a little bit more. I'll take a trip. I'll go ahead and buy something, whatever it is, because I feel that. So there's a correlation between improvements in consumer confidence and PCE, right? Those are personal consumption expenditures. That makes up 70% of the economy. So not surprisingly, we keep seeing retail sales come in. They're strong. And that's because of this improvement that we're seeing in consumer confidence. But it's still extremely low. Right? It's still extremely low relative to historical norms. And so it doesn't quite jive with what we've seen going on in the markets. But the markets are no longer really representative of what's happening in the real economy, because we used to trade on fundamentals, right? We would look at a company and we'd say, okay, this company, A, B, C, whatever, based on its earnings and its growth rates, we're going to assign it a valuation, and so this is where the stock should trade. And we used to back 400 years ago when I first started in the business, we bought stocks based on fundamentals. Now we don't. If we did, you wouldn't have companies trading at 20 and 30 times price to sales on a consistent basis, right? What we buy now is we buy liquidity. And this has been a advent of the markets really ever since 2009, coming out of the financial crisis when the Federal Reserve began massive rounds of quantitative easing, zero interest rates, etc. And we can go back and we just can look at the markets, and ever since the Fed has become extremely active. And you can note that the increases and contractions in the balance sheet have become extremely exaggerated since 2009. But when there are periods where liquidity is increasing, in other words, the Fed is cutting rates and expanding their balance sheet, markets go up. When we're in a period where the Fed's hiking rates and contracting their balance sheet, markets tend to struggle, except this time. This time was different because after 13 years of this environment, investors learned it. And so now they front ran it. So even though the Fed was still contracting their balance sheet and hiking rates, markets went up in anticipation of Fed rate cuts and interest rate reductions and increases in balance sheets, etc. So it's a very different environment today, which is why there's this dichotomy between the markets and what's happening in the real economy, right? Around the kitchen table. You go sit down with a family and talk about their financial situation. It's not great. But the markets are doing fantastic. And it's interesting because when you take a look at the financial markets, it is now all about liquidity. There was a recent survey out from Bank of America, and they asked people, they said, what's the biggest driver of prices in 2024? 52% said the Fed, 7% said liquidity, and that 7% is actually controlled by the Fed. So it's actually 59% of the drivers for the stocks in 2024 is going to come from the Fed. So again, it's all about liquidity. It's all about the Fed. It's no longer about fundamentals. So that's why the markets are pinging all-time highs despite the fact that the rest of the economy is not great. And unfortunately for the markets, it's a very lopsided investment. We'll come back after the break. We'll talk about market dynamics over the last couple of years because of Fed liquidity and the chase for growth. Don't go away. I'm your host, Lance Roberts. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Kids these days, they're always inventing something new. So have you heard about this new thing called Scrawlish? Scrawlish. It's a new way to write.
The Real Investment Show podcast.
So yeah, it uses a set of symbols to represent letters. And that way you can theoretically write faster, right? Take notes. It's very cool looking on paper and nobody can read it.
At realinvestmentadvice.com.
It's also called shorthand. We developed that like 50 years ago.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Financial Fitness Friday, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just for the break, talking a little bit about this interesting kind of gap we have right now between the markets and the economy, and at least economic sentiment, consumer sentiment in particular. And again, poll after poll just it really kind of comes down on the fact that the average American is just not happy about things in general. And this is a time going into the election, and which is interesting because, again, market's hitting all-time highs, the economy's doing fine, unemployment's low. I mean, for an incumbent going into re-election, I mean, this is the perfect setup. But yet the polls don't suggest that. Biden's approval rating right now is at some of the lowest levels ever. So again, there's this big disconnect between the markets and people and what they show. And we're talking about the fact that it's all about liquidity now in the last segment, and it's all about the Fed, and that has just become simply a chase of growth. And if you take a look at the market, really ever since 2020, go back to 2020, January 2020, technology is the clear winner by far. In fact, every other sector has performed worse than the S&P 500 on average. And this is just price, by the way. This is not performance, just price. But again, technology has pushed, and then of course that's also one of the largest sectors in the S&P, which is why the S&P continues to grow. But technology is just where money flows, right? So we go back to talking about Apple, Amazon, Google, Meta, these companies, right? And it's just been safety and liquidity, ETF flows. We've talked about all the reasons why this is the case, but it's the Magnificent Seven. All last year, and so far this year, it's been the Magnificent Seven. And so this has been the real conundrum. In fact, we showed you this chart last year. So for 2023, the S&P 500 market cap weighted, which is dominated by those 7-10 stocks, those top 10 stocks make up about 30%, 33% of the index and capture a big chunk of the inflows. It had basically double the performance of the equal weighted index. This year, so far, now this chart's a little bit dated. It doesn't have yesterday's numbers in it, right? So this is as of Friday. But as of Friday, the market cap weighted index was up 1.5. The equal weighted index was still negative for the year. So again, back to the same disparity in performance with just a handful of stocks really kind of driving overall market returns. And, this is just a function of that liquidity flow having to go somewhere. And so it's going into safety. It's going into the areas where I can get, easy in, easy out, and where I'm going to get almost what has now become guaranteed performance, right? So earnings, though, are going to be the key for all of this, right? As long as earnings keep growing in those companies, as long as Apple and Microsoft continue to crank out earnings, this is going to last for a while. But if you take a look at the S&P 500 versus wages and savings, right, there's certainly a bit of a disconnect here. So as the average American, I only have so much money to spend. Excuse me. Wages are declining on an annualized basis. Savings are, all those excess savings that we had back from 2020, they're becoming depleted. So the question is the ability for these companies to continue to grow earnings at the rate they were growing earnings. And this is, as we talked about previously, what's been driving economic activity so far and driving earnings for these companies has been deficit spending. And we've had this massive surge of deficit spending as the economy is contracting. We're building chip plants and we're building manufacturing facilities and all this. And so that's requiring computers and chips and technology. And we're doing all this AI development now. Meta spending billions on NVIDIA chips to integrate AI. Amazon's doing more AI. So we've got this spending that's going on through deficit spending. So we're increasing our debt, but it's keeping economic activity alive at the moment. That's keeping jobs. That's keeping things happening. But it's not, again, deficit spending and what happens in the markets does not really translate to the bulk of the economy. Roughly 86% of the stock market is owned by 10% of the population. So There's a huge chunk of the population that has no participation in the financial market. So it's not, they don't watch CNBC, right? We talked about this yesterday. If you're listening to the show, you've got some skin in the game, but you're a small minority. You're a very small minority of the country. That's why, financial podcasts don't even make the top 10. It's not what people want to listen to because they don't have any money. I don't want to listen to a podcast about money when I have no money. That's just depressing. So, you should just do this with your money. Well, I'd love to if I had some. But this is why it all comes down to earnings. And the one thing that we're going to have to come to grips with is that earnings growth isn't as strong as we're pricing the markets to be. And at some point, valuations are going to matter. Question is when, we don't know. But at some point, we're gonna have to realize that the earnings growth that we're expecting is not there. In fact, I've showed you this chart a couple of times, but just since the initial estimates for 2024 came out, they're already down $10 a share. And those are going to decline more as we get further into this year because earnings estimates can't keep up the pace that Wall Street expects them to currently. And then we talk about valuations. What are we paying for those earnings? And the deviation of earnings currently from the long-term trend is just is near some of the higher levels in history, right? And they're not sustainable at these levels long-term. You're going to have a valuation reversion at some point. The question is what's going to cause it, right? And that doesn't mean tomorrow. That doesn't mean it's going to happen this year. I mean, this is something that could happen a decade from now, right? It's just that there is an instant sustainability of valuations from their long-term trends currently in the markets. So, as we talk about, the markets at all-time highs, there's this big disparity between the average American and everybody else. Well, and the big chunk of that disparity is that the average American doesn't participate in the stock market. But the important takeaway from this is that these all-time highs are driven by a massive flood of liquidity and expectations of more liquidity from the Fed through rate cuts, reversal of QT, going back to QE, buying bonds, those type of things. What that means going forward is the interesting question. As I've said before, we spent $43 trillion over the course of the last decade to generate the levels of economic growth that we had, moderating at 2.5%. We kept interest rates at zero. We suppressed inflation. To get the financial market returns that we got was due to all that liquidity. The question is going forward is, where's that liquidity going to come from? Are we going to do more? Are we going to be doing more QE? And the answer is probably yes, by the way, but it's a rhetorical question. The question is where is that liquidity going to come from? More QE, more deficit spending? Yes, that's where it's going to come from. The question, of course, is when the bill comes due. The mistake that investors make right now is assuming that bill is going to come due tomorrow. That's not the case. But there is a negative knockoff effect of continued increases in debts and deficits, and that is slower economic growth, less economic prosperity, and greater divides between the rich and the poor. QE as a function and zero interest rates as a function are a wealth transfer mechanism from the middle class and the poor to the wealthy. The reason that is because the wealthy own a big chunk of the financial assets. The wealthy own the production side of the equation. They're the business owners. They're the ones producing the electric vehicles. They're the ones producing, the gadgets you buy in your house, etc. Those are the wealthy for the most part. How many poor people that own a company? Okay, so mostly wealthy people own those manners of production that those products are then sold to the middle and poor classes. So the more that we boost the liquidity in the system through deficits, etc., the more wealth that gets extracted over time. And that's why there's this continuing gap between literally the haves and the have-nots. And this is why it's always important when we talk about, hey, if you really want to build wealth, you don't really build wealth in the stock market. The stock market is what keeps you wealthy. If you want to build wealth, become a provider of the means of production. You don't want to be on the consumption side of the equation. That's where you really build wealth at. And that's the function of capitalism. Anyway, quick break. We'll come back. We'll wrap up the show. Earnings coming in this morning. Also, we got some other data to click through here real quick as we get ready to start the day. Futures are flattish. Come back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. All right, so that whole conversation that we just had about markets and earnings and those type of things, that's today's article on the website. So if you go to realinvestmentadvice.com, go to the Insights tab. It's today's blog. It's right. It's the first one that's listed on the Insights tab. So all the charts and graphs are there, and you can kind of go through the analysis yourself if you'd like. Like I said, Newsmax asked me to write that article, so that was the reason I wrote that article. Coming up Friday, I've got an interesting article coming out about retirement. Some interesting studies coming out here recently. So the impact of equities in retirement. So, and of course, Saturday, of course, we have the summit. And next week, I'll make available my slide deck if you want it from the summit. You don't get the conversation. You get the slide deck. If you want the conversation, you have to come to the summit. So, love to see you there, by the way. Like to meet you. All right. So, this morning, futures are up a little bit. Interestingly enough, Bitcoin is at below 40,000. And, we talked about this last month, not this past Monday, but the Monday before last. That was when they launched the ETFs, right? The Bitcoin ETFs. And, at the time I said, I don't know how this is really going to work because this, all this demand, so if I buy a spot coin ETF, right, I buy the ETF and then the ETF's got to buy the Bitcoin, et cetera, should have provided, I would have thought a boost to Bitcoin. It's been just the opposite. Ever since the announcement of the Bitcoin ETFs, Bitcoin has slid. This past week, there were net outflows of most of the spot Bitcoin ETFs. So, it's been kind of an anomaly here. Now, one side item of this that is putting pressure on the whole issue, and this is one of those timing couldn't have been worse type situation. You remember the whole FTX scam that we talked about? This is Sam Bankman-Fried and the whole FTX thing. Well, FTX had a couple of $1 billion worth of grayscale Bitcoin trusts that got liquidated this past week. So at the time that these Bitcoin things are being launched, there's this big chunk of liquidation of FTX's grayscale Bitcoin trust. So you subtract those outflows, from the inflows, and that was part of the problem. So again, this may resolve itself, but Bitcoin is again, it's lower this morning by about 3.5% at the moment. So, it's I'm waiting for, kind of some stability in these ETFs. And again, if we can give them a little bit more time here, and I'd say give them a couple of months. If you're interested in these, all right, I'd give them a couple more months. And the reason I say that is for a couple of reasons. One, you can start to have a little bit of technical analysis, try to see, kind of where were some support levels, where are buyers showing up, where are sellers showing up, those type of things. You also kind of see what the correlation is between the ETFs and the actual price of Bitcoin. It should be, since these are spot, they should be fairly close, but we'll find out, right? I will also find out who the winners and losers are, right? It's going to be, if you were going to ask me to bet right now who the winners are, it's going to be BlackRock, it's going to be Fidelity, it'll be the big boys, right? Because they just have access to the flows, and they can put tons of money in their own ETFs as well. But give them a couple more months; these things will sort themselves out, and then we'll kind of see how they start to trade. I thought there was an interesting study out this morning. And again, we talked about stupid studies at the open of the show this morning about, all-time highs tend to cluster. Well, of course, right? Because you're in a bull market. There was a very interesting study out. They said, what would happen if you added Bitcoin to a 60-40 stock bond portfolio? Now, the reason you own a 60-40 stock bond portfolio is have lower volatility, right? That's the whole goal. I do 60% stocks, 40% bonds. I theoretically get some market participation. I have less drawdowns because of the bonds, etc. And so if you introduce Bitcoin, surprise, you increase the volatility. Your risk of drawdown increases sharply by even adding just small amounts of Bitcoin to your portfolio. So if you're a conservative investor, don't add Bitcoin to your portfolio because you will not like the drawdowns that occur. But again, it's just kind of an interesting study. It's like you didn't know this going in to the study. I mean, there's some studies that you should just go, I really don't need to do this study because I already know what the outcome is going to be. Common sense will tell you. It's like we spend hundreds of thousands of dollars or millions of dollars figuring out how a Frisbee flies. Those type of things, right? That's government spending at its best. But, well, again, we kind of give this, I'm getting a lot of questions right now. Hey, should I add this to the portfolio? I would just wait. This is kind of like an IPO. We talk about IPOs a lot in the past, and especially when we're going to kind of go through that rash of issuances and the SPACs and those type of things. We went through that whole little phase. Give them some time. See how they're going to trade. See how they respond to Wall Street. How does the management operate? Get some track record of the price behind you so you can see, again, where support levels are, where resistance levels are. Yeah, sure, you miss some of the initial, right? But if it's a good company, plenty of time to get into the stock and get it. And in a lot of cases, right? Remember, an IPO, just like anything else, and these Bitcoin ETFs are another good example of this, they tend to get issued near peaks because that's when greed is the highest. So going into these Bitcoin ETF launches, Bitcoin was running up in anticipation of these launches. And so now people are taking their profits, right? Same thing with IPO, same thing with SPACs. This is why you just kind of wait. Just whenever it's a new product or a hot new thing, just give it some time. Generally, and again, this is like with IPOs or anything else, they're being issued out at the peak of greed and exuberance. And so initially that is going to pass. Those IPOs are going to decline in price, and you can buy them a whole lot cheaper. Take a look at a chart of Palantir or a lot of these other companies. Palantir is a good company, right? They're on, they do contracts for the military. They're into AI. They're into all that. Stock's been rallying here nicely, but if you bought it on the IPO, you spent a lot of time in negative territory, right? So you had if you just waited, you could have bought the stock a lot cheaper, kind of worked off some of that IPO premium, and gotten into the stock later. And there's just a ton of these stocks, right, that are like that. And particularly after 2020, when we saw that rash of IPOs come out, everything under the sun was getting IPO'd. We saw a lot of those stocks decline by 60, 70, 80, 90%. So you could buy them a whole lot cheaper, and they're still here. Some of them didn't make it, but a lot of them did. But all that premium's been worked off. So that's why you just, again, not always the case. It's not always the case. I've seen IPOs that just went up and just kept going. Right? It just doesn't happen often. Generally, you get a better opportunity to buy it cheaper later. And again, it's just simply a function that we IPO stuff out. We launch Bitcoin ETFs. We do whatever it is kind of at the peak of exuberance. It's just because at that point, right, and this was our whole conversation that we had back in 2021 when we were doing SPACs and everything else, is like there's a huge demand for product because everybody's got money to spend. We send checks to households. So every teenager with a phone is now online wanting to trade stocks. So there's a huge demand for product. Wall Street's job, its only job, is to provide you product. Wall Street is not there to help you. Wall Street is not there to make you rich. Wall Street is not there to give you good advice. Wall Street is there to extract your capital. That's their job. Wall Street is a sales organization. They are there to sell you a product. They are there to extract your capital for their bottom line. And the sooner you realize that, as soon as you realize that about ratings and all this other crap that comes out of Wall Street, the better off you're going to be. Start doing your own research. Look at the actual reported data from these companies. Make your own assumptions, and you'll do better as an investor over time. Stop listening to Wall Street ratings because they're not for you. All right. See, you got me on a soapbox. Stop that. Anyway. This morning, we already talked about Procter & Gamble. They had their earnings out this morning. 3M, Halliburton, Johnson & Johnson this morning as well. Lockheed Martin, Netflix is today, so keep a watch on that. Verizon. Tomorrow, got a good bit of economic data coming out. We're going to see global services, the S&P Global Services PMI and manufacturing PMI. We're about to start getting into inflation data. The next week, we have the FOMC. So the big thing for next week is, does the Fed try to walk back some of this exuberance that they launched into the market back in December? That's going to be the big question for next week. All right, have a great day. We'll be back tomorrow with Danny Ratliff. talking about markets and money. We'll talk about what happens in the markets today. Also, make sure you get your tickets for the upcoming summit this weekend. And if you have any questions or comments, get by the website, realinvestmentadvice.com. Send me an email. Always happy to answer your questions. Have a great day.